sessions, I'm gonna like specifically look at property. Property is something that's very, very close to, I think, most people's hearts. I think you just throw a stone and you'll be hitting people with an opinion on property market because our home ownership here is so high. We are talking about, globally we are the tops, over 90%, right? So practically every Singaporean and their dog would have an opinion on property. So it's a very sensitive topic. I'll talk more about, my outlook on property market and maybe the general stock market. I'm sure I have some time, 15, 20 minutes towards the later session. But before that, I want to introduce you to an old friend of mine, Jack Chua. He's the CEO of APAC Realty, which is the parent of ERA. Jack, how are you doing?
Hey, Hank. Good afternoon, everyone. Yeah.
Jack's an old friend, like I said. Do you remember when a little bit of a trivial pursuit? Do you remember when we met up? First met up?
Long time ago.
Long time ago. I give you a hint. I mean, like, I remember vividly we met up just before I got married. That couple of months before I get married. So, and I just celebrated my 13th wedding anniversary. So we met up. So we know each other for over 13 years, really.
Yeah.
Right.
Okay.
So,
not that long. I've been with ERA for 30 over years.
I know. You're a stalwart. You're like a very experienced agent that have like moved through the ranks to become the CEO. At that point in time where I know you, you were still the CEO of Hersing. Hersing at that point, I remember had three distinct units, right? ERA, and then there was a remittance business, Western Union, which is very, very popular. And then there's also Store Hub, right? Yeah. And I think so. Jack actually ran all these, but I think the thing that's closest to his heart, because like I said, he was born as an agent. ERA is something that very close to his heart. Hersing was privatized. When was it? 2010, 2011?
Yeah, correct. In fact,
the owner had
what? Tim Ho Wan. Have you heard
Sorry?
of Tim Ho Wan? The F&B business. The
Tim Ho Wan, yes. Hersing went into Tim Ho Wan, right? But were you involved in Tim Ho Wan also?
I started that business.
Oh, you okay. Because at that point in time, I thought you already left Hersing. So you were still in Hersing and started Tim Ho Wan, right?
Before Hersing delisted. Yeah.
Oh, okay. Now I get the timeline right, because Hersing's founder, Harry Chua, which is not related to Jack Chua, right? Yeah. They always have that in a media interview. I mean, Jack is a professional manager. You brought in Tim Ho Wan, and so you have a bit of F&B experience. But like I said, I think that property is still in your blood. Right?
Yeah.
First up, I want to really ask you, there's, because when I first introduced you, there's APAC Realty, then after that there's ERA. People know you as a ERA person. Why is there APAC Realty right now as a listed entity and not ERA?
Okay. I suppose that basically we want to concentrate in the Asia Pacific region. So that's why I call APAC Asia Pacific, because for ERA brand name, I mean, it's a franchise from the United States, but we're not only holding the master right for Singapore, we also holding the master right for the Asia Pacific region. That's include 18 countries in this region. And now we have operation in 10 countries. In fact, we also in the process of acquire all this, okay, to have our presence in all this, because we feel that Singapore, no matter how, I think is still small. I mean, it's an important country. I mean, you look at the Asia Pacific, I mean, it's a growing and all this important, but again, in terms of sizes, is still very small compared to the rest. That's why we want to go into the Asia Pacific region, and ERA really give us a very good gateway for me to venture into all these countries. So at the moment, I mean, after we are listed in the stock exchange, so we start to acquire. Now we 100% of ERA Indonesia. We hold 80% of ERA Thailand. And lately, I think you saw the announcement, we acquired 38% of ERA Vietnam. And we also venture into the Malaysia and the KL and the JB market. So we also have participation of 49% in this Malaysia, in ERA Malaysia. So we think that Singapore is important. Okay, I feel that it's still very important. But again, all these neighboring countries that have our presence is equally important. That's why we are venturing into this. Of course, I mean, we can't see the result tomorrow, but basically we will see the result in the very near future.
So what is the concentration in Singapore right now as a percentage of the total, given that you have like expanded overseas? It is still your core and the most important
Yeah,
market, right?
I
By
call this.
far.
I mean, maybe we contribute to maybe 70% of the total, but I
Mm,
must say that the Asia Pacific is building up because in the old time, all these are franchise. Even like Japan and Korea is still franchise. That means they only pay a loyalty fee to us. But again, now in Indonesia, in Thailand, in Vietnam, we are participating in the company. So the profit and loss, the revenue were locked into APAC Realty.
mm. So on Singapore, or even because you're talking about franchise, you're talking about commissions, like how do agencies like yourself really make money?
Okay, I must say that in Singapore is quite a unique business model because basically all my agents, we consider them as independent contractors. So the company will provide a platform and support all these agents, okay, to do their business, okay, using ERA brand name. And
Mm.
I think that we don't really pay basic salary. So we are using the format of commission speed. So the agent, I mean, who are very productive will like this type of format because basically the more hardworking they are, okay, they are closing more deal, they will enjoy more commission. Yeah, so that is the format. In fact, this format have been quite widely used now, okay, even in the Asia Pacific region. So we are implemented in Indonesia, in Thailand, and even in the new country, Vietnam.
But is the split, how is the split like? I just want to give the viewers, the listeners, like some idea, some semblance about how, an
Okay,
agent and an agency split the comms.
the split is very motivating for the agent because
Okay.
majority part of the commission will go to the agent. That's why their hard work are rewarded. Okay, of course, as an agent, there's also overhead is quite hard work. I mean, you see the agent may earn commission, but behind the scene, okay, there's a lot of work to be done in order, okay, to advise the customer that what will be the best investment. So that's why I think agent, in fact, in this the whole transaction is quite important. They are not purely just to find you a property. They are here to advise you. So if they give you a wrong advice, actually will cost you a fortune. That's why the ethic of the agent is very, very important because as a professional agent, they will not just look at the commission. They'll look at, I mean, whether your financial eligibility or capability, whether you're able to invest into this property. As you know, investing in property is really, I must say, is really a very good long-term investment because in
Mm.
the long run, I mean, if you look at Singapore context, definitely the property prices will increase. I can 100% chalk and stamp.
100%, 100%.
Definitely will increase. So is whether you are able to withstand this period of time. And
Mm.
also property is not say so liquid, okay, as per stock. So you must able to withstand, okay, and I mean have the power or ability to invest. So that's why agent ethic is so important because they really have to advise the customer, okay, looking at their financial situation to invest in the right property.
Yeah. Speaking of the property prices, remember in 1996, 1997, while people were queuing up Ardmore, right?
Yeah,
I remember vividly in 1996 there were two very long queues. One was queuing up for Ardmore, and the other one was queuing up at McDonald's for Hello Kitty, right? The lines were crazy long, right? First, and then the next time round there was this craze was in 2007. I remember going to some of the show units. I was living in Caribbean at that point in time. Then I was invited to my sister unit, Reflections. People were thronging there. I mean, like even before they go to the show flat itself, they went straight to reception. They started throwing checks at writing a unit and just throwing checks. I've never seen that before. Right? During these crazy times, agents must be making versus right now. But I did hear that developers are also upping the commissions because back then when it was so easy, it was probably what 1%, 0.5, 1%.
too easy job where got give you high commission.
Right, yeah, yeah. So that time was what? That time must be what? Sub 1%, right? It's so easy. You just sit down there. You don't have to do very much, right? The
uh,
checks are just flying in your face.
no, no. I suppose that situation then and here now is different because at that point in time, if you all can recall, actually there's no control at all. You can get even 100% financing. Okay.
Ah, yeah, 100% financing.
I think it's different. I mean, you know, there's a TDSR, there's a lot of control. That's why you eliminate a lot of speculation. It becomes genuine investment. So to do a genuine investment, then the agent role will be quite important because they really advise you, okay, whether you are eligible or not. It's not speculating because at that point in time, it's more speculating because 100% loan, you don't need to think anything. I mean, you sure can afford because you don't need down payment at all. Yeah.
Right,
So
yeah.
it's a bit different situation. But again, at that point in time, if you think that the property prices are expensive, now if you go back, wow, at that point you should buy the whole block.
100% financing, right? Yeah, but in '07, I remember also, I mean, I most remember the '07 because that's the time I met you. The market was very perverse because the luxury guys were doing a lot better than the mass market. Mass market only started to surge in '09, but in '07, it was the luxury guys that did it. And the strange thing was that PSF-wise, some of the bigger units were sold at higher PSF. And like it sort of like defies conventional belief that you have to be Mickey Mouse, you be shoebox in order to sell high PSF. 2007 was really, really a very strange year. But in '09, after that, it was just mass market.
Because 2008 is a financial crisis.
Yeah.
Okay. So it rampant the whole thing. But again, I think this crisis will recover very fast. Okay, so there's something like pent-out demand type of thing. So the transactions volume has shoot up after that. Yeah, I believe that like in today's situations, it's a bit similar because I mean I must say that during the COVID-19 the circuit breaker period, people are a bit deprived from buying property. So maybe after the period, so we really see that really, I mean, from April, May until now, they really have increased interest in the property purchase. I mean, we don't have any evidence, but if you can take evidence from China, because China will be was the first country that walked out from the COVID lockdown situations. So they are open in April, May, and they're really a pent-up demand for their property in 70 major cities. In fact, the price even increased by 0 point something percent.
Yeah, I see some of them, they're like 70, 80, 90% sold on the first day, some of these Chinese properties.
There's a pent-up demand. I mean, you can see it. So I of course I hope, okay, and Asian will apply in Singapore because I mean over the past 2-3 months, no doubt there's still transaction, but again the transaction volume have dropped. So I believe that when this is reopened, okay, there may be a pent-up demand for the property.
Okay. On the topic of demand, there have been, because of all the cooling measures, particularly the last couple of cooling measures, foreign participation have hit, I believe, one of the low points, right? And they are covering, I don't know, 5, 7, 8% versus at one point in time, the 20 to 30%. Do you see them coming back, or do you see like the government trying to revise or trying to go back on some of these cooling measures in order to bring the foreigners back? Because I think in the previous runs, particularly the one in '06, '07, it was driven largely by, or it was first driven by the foreigners before the Singaporeans started the frenzy.
Okay, seriously, if you ask me how is a cooling measure, okay, of course, I must say is no good. But again, because of cooling measure, really it eliminate a lot of speculator. Okay, so all
Absolutely
these
agree on that.
very genuine demand, and all these are also I mean, it's also affordability issue because of the TDSR. So all these people also really can afford to invest or to purchase the property. So it is really eliminate a lot of bubble problem, whatever thing. So all these are very genuine. So the price that slowly increase also is really due to genuine demand. Okay, a lot of people will say that maybe Singapore will go into oversupply, whatever thing. But if you look at the figure, okay, there are about 30 over thousand balance unit available now. But if you based on the past year record, okay, every year we can absorb about 10,000 units. So the 30 over 1,000 can easily absorb within the 3-4 year, which is within the deadline of the government that given to the developer, the 5 year that you need to dispose of everything. If not, you have to pay the extra additional stamp. So if you look at it, actually it's quite balanced. So the situation is quite healthy.
Yeah, I do agree with you on the affordability part. A lot of people say, hey, Singapore, the property, wow, so expensive, right? But if you look at it vis-a-vis the likes of, don't say Hong Kong. Hong Kong is like way off the charts. I mean, Singapore, we're talking about 5 to 6 times the affordability index, right? Versus Hong Kong is like 19 to 20 times.
Yeah.
But you have things like Vancouver, Sydney, they're going at 10 to 12 times. And even the smaller cities like Toronto, they're all going at 7 to 8 times. So Singapore, comparatively is cheap, right? And I think that and they're okay, affordable. I mean they're relatively affordable.
Yeah.
So that could be I think that if the like back to the cooling measure, if it were wouldn't say completely lifted, I mean if it become relaxed in a certain way, that could drive certain international or at least foreigners to come back to look at Singapore. And I think that if things become dire, that may be one of the particular measures that that the government can utilize. We had like what 9 or 10 cooling measures, right? Surely
Yeah.
and
And
surely we
cooling.
can reverse some of them. So surely
Yeah.
we have some capacity to reverse some of it. It's not like say back in 08, 09 where it was hardly cool. Then they started to fall, right? And there's really like very, very few policy levers that the government can pull. Now they do have the capacity to pull quite a few of them. So whenever I talk about stock, right, people always go, hey, this stock can buy or not? That stock can buy or not? But with you, I'm sure people will ask you, this property can buy now or not?
At this moment. Yeah, I suppose that there are quite a lot of good factors. I mean, if you look at it now, the interest rate is really very low. Okay, if the interest rate drop by certain percentage, actually is amounting to quite a good discount for your property, because I mean, everyone borrow money to finance a property. So it's like a discount, because a drop in certain percentage, it can amounting like a saving of 100,000 of your interest. So this is like a discount to your property. And also, if you look at Singapore in the long run, okay, whether you have confidence, I mean, the most important is whether you have confidence in Singapore now. If you think that you have confidence in Singapore, definitely the prices will go up. Okay, if you look at the nearby country, in fact, after this COVID-19 situation, I believe that we will become a hotspot for the nearby country. Because I mean, if you look at the situation in Singapore, of course, it's not really then perfect, but again, the control, everything, I mean, the healthcare, everything, I mean, our death rate is so low. So basically,
Yeah, it is the lowest in the world.
yeah, so people have confidence that you are able to contain the virus within certain, zone or whatever thing. So have confidence, and they if they want to invest, that will be the good area for them to invest, because that is the place that they can see appreciation, and they also can preserve their value. Okay, that is the most important, because it's really a good country. So in the event if anything happen, they still can run to Singapore. I think so.
That's good. That's good. ERA has been here for many years. Like you say, you have been ERA for 30 years, and the company ERA as an agency has been here for what 40 years. I know I was a little boy and I've been hearing about ERA already.
Started in 1982. Yeah,
82 over in Singapore, is it? And you
correct.
joined just a couple of years later.
Yeah, I joined in 1990. So old man in the industry.
What are your mid to long term plans for the company then?
Okay. I suppose that we have been here for a long time. So basically, we are here for long-term business. We will not be hit and run type. Okay. So I think the image of the company, okay, whether we do a lot of transaction or not, that is also, that's important. But again, important is the image of company. We really need to project. We need to be professional, because a lot of time, I think some of the agent may just want to make quick money without really advising the client correctly. Okay, then it's really caused a lot of problem to the customer, because investing in property is not small amount. It is normally huge quantum. So we really have to uphold this ethic. Okay, make sure that we provide good advice to the customer. Okay, it's not looking at just the short-term commission. Okay, it's more to really service the customer. Then they will come back to us again, because I mean, if you look at Singapore context, about every 5-6 years, people will change house. Okay, so if you are looking at long-term business, so you should provide good service, so the customer will come back again, and they also refer their fan to you.
Okay. That's good. At this juncture, I mean, like now that we have gotten a much better idea of what APAC Realty is all about, I want to bring in an analyst, RHB analyst, VJ. Ethan, can you bring VJ in?
All right. Give me a moment.
You know, as he's bringing in, I just want to tell you a little bit of history. Jet, they privatized.
Hi, VJ.
Hey, VJ, how are you doing?
Good, good, good.
VJ is an analyst with RHB. He's been an analyst for, I think, almost 10 years by now, 4 of which was with RHB. I was with RHB too, but then after I left, then he came in. So our paths never really crossed.
Yeah.
Back to APAC. APAC was actually listed in 2017. I worked closely with VJ because he was also presenting me this story. And it so happened that I know Jack for many years. So it was something that I knew from before, but VJ is very helpful with providing the information, and he goes down micro. He understands the business very well since its IPO is involving the company. So VJ, what are your thoughts on APAC Realty? We'll just pretend that Jack is not around. Give us your lowdown.
I'm happy to share. When I started looking at this business in IPO times, what attracted me to APAC Realty, or what was the key selling point, is that the business is very simple to understand. It's not rocket science. It's very simple. Directly, if you agent sell a projects, you get a commission. It's simplicity. At that point of time, they were in net cash. There was no debt, and it was very high ROE generating businesses. And these were all the virtues of a very good company at that point of time. And they were the first one to be listed in Singapore. So there was this novelty factor also. Although they were with Hersing as a part before, at that point of time, I don't think so people looked a lot into ERA or the business as it is. But when ERA started listing an IPO, I think investors understood it. And it also coincided in a way with the upcycle of the property market. Of course, the stock has went up its highs and has come down to its lows. And we all know the story of how PropNex came in. There was 2 agencies, investors started switching, then there was cooling measures. But as I said, this business is very simple to understand, very easy, very high ROI generating. But keep in mind, this is also very cyclical business. And that's the something which investors has to keep in. And that's what I think ERA is also trying to mitigate, the cyclicality of one market of Singapore, trying to diversify. At this point of time, I know it's very small, but if they can successfully do it, maybe in 5-10 years, they can mitigate some of this vulnerabilities to exposure to single markets, in my view.
Okay. Thanks, VJ. Hang on first. I'm looking at some of the Q&A right now. There's something for Jack. I saw today on the Edge Singapore Online that APAC Realty saw a decline in transactions in April and May. No surprises there, right? Due to the restrictions on home. Yep. May I ask Jack if today's BT front page news regarding the almost twice the number of new home sales in May from April tells only part of the story of the overall market?
I must say that when the CV or circuit breaker started, okay, in April, really the transaction dropped a lot, because on the average, because new home, like 2019, we are looking at about 10,000 transactions. So if you take 10,000 divided by 12, basically we are looking at about 8,000 plus per month. Okay, but again, I think in the month of April, okay, there are only about 800
plus, 800 plus, yeah.
800 plus, but in the
we'll be very happy with 8,000 plus a month.
200 something transactions. So actually the transaction dropped a lot. But again, people are starting to use to the virtual tour and everything. So you can see that the May transaction have picked up. Okay, but again, if you ask me, it's still below the 800 over mark. Okay, so basically you can see increase. That's why I must say that people still really have interest in property. It's only because of the circuit breakers they cannot visit the show flat. And some of them maybe feel that technology is still no good enough for them to go for virtual tour and commit. So they are waiting for the market, the government to open the show flat again. So they will come in. That's why I expecting that once the situation is improved, we are allowed to view the show flat, the pent-up demand will be there. But again, for month of April and May, you can see the transaction increase, but again, still below, okay, the average of every month of 800 over transaction.
Okay. There's this other question by Jimmy. Jimmy, yeah. Hey, Jimmy, how are you doing? Anyway, he's asking, and this question I pose to both of you. I also like pitch in. Do you foresee relaxation of cooling measure this year if price falls? Relaxation may be good for government to raise revenue from stamp duties to replenish its coffers. May I take Vijay first?
Okay, I think the government over the last decade has made something very clear. What they want property prices to do is that property prices should move in line with economic fundamentals or what the market fundamentals. And that's why they have put in 10 rounds of cooling measures. And as you rightly pointed out, government is in a much better shape to tweak the policy measures if there is necessary. My take is that if property prices fall by about, let's say, low single digits or mid single digits, I don't think the government would step in and make a relaxation. But if there is a deviation between fundamentals, let's say the GDP outlook is about -4 to 7%. So the expectation of government is that property prices, if they want to move in line, that should be the range at which property prices should move in. But if they see the property prices falling in much faster rate, I believe government has a lot of ways to control the market. Definitely supply is one, but supply takes some time. I think the other possibility is extension of ABSD deadline by another 6 months. And in the most critical case, the ABSD for local buyers could also be tweaked lower if there is need. So it all depends on how the buyers react or whether there is going to be a lot of price cuts. If there is no price cuts and if government relaxes prematurely, there is a possibility of overheating in the market. As Jack rightly pointed out, there is bias, but it is just at what price is my view at this point of time. So it depends on how the market goes, in my view.
Jack?
I mean, if you can recall, actually it happened, okay, before the 2018, they reduced the SSD, the seller stamp duty, 4 years, 2 years. Okay, it really excited the market. So I think government will be quite, be really very careful, okay, whether to relax the measure, because any of the cooling measure that they relax, definitely will excite the market. Okay, it's only to what extent, because it's a sentiment issue. People will think that, hey, government maybe want to do more, so they will come into the market. So it's really, they really have to monitor closely. As what Vijay pointed out, if really the price have dropped a lot, then they may have to do something, because they are very worried that the price just excavate too much.
Okay. Then with regards to, there's this other question regarding the property in Haw Villa MRT station. He said he's shocked that, it hasn't gone up at all. In fact, it's gone down. He just doesn't understand why, property prices has not moved in the secondary market after 10 years. But, around that vicinity, NUS area, they're still like looking for record high primary market prices.
Okay, I must say that most of the launches, okay, because after they are TOP, they are very new, so they are very rentable. Okay, so normally the prices are better, are able to hold better. But when the property are getting old, okay, so I think the rentability will not be there. Okay, I mean, very obvious, if you are going to rent a property, okay, one is brand new and one is about 10 years old, definitely you don't mind to pay a little bit to go into a new property. So the rentability is better. So once it's better to rent, of course, your prices will be higher. That's why people are going for newer property, and newer property are more expensive. But again, I think in the long run, definitely the prices will still increase. So I think when it comes to launches, so selection of location will be quite important. Make sure you select location that is really, is demand is there, is very popular, whether if the demand is good, I mean, easier for you to rent out, or easier for you when you want to sell it, when you want to dispose. I mean, you know, everything is demand and supply. The better, I mean, the more demand and the less supply, definitely your prices will go up.
VJ, any kind of like new launches by any developers? Because VJ also covers the developers well, after all, he's a real estate analyst, right? So any interesting developments that's going to be pushed out? And what's your general view of the property stocks?
I mean, I think if you ask me 2-3 weeks before, I think property stocks were really cheap. Recently, I think the last 2-3 weeks, there has been a bit of rally in across property, not just property, real estate as it is. I think it's all fundamentals of, again, coming to interest rates. There has been much more liquidity in the market at this point of time, and there is a lot of liquidity driven rally going on. If you're ready to take a 2-3 years view, I think the property stocks are still cheap. If you look at the current valuation, it's still about 40 to 60% discount to their RNAV valuations for property stocks. And property stocks these days also give a decent yield of about 2 to 4%. So it all depends upon the time frame at this point of time. And I think the property stocks, if you're ready to take, there could be some near-term volatility in the property stocks. But if you take a 2 to 3 year time frame, I believe you would definitely make at least 20-30% kind of returns from the property stocks. And in terms,
the price to RNAV, it is currently still trading at a significant discount, right?
Yes, yeah.
About 30-40%. At one point it was like 50%, right? But yeah. I think after this run up, it's probably closer to 30-40%. Right? So you think that in the next couple of years you will see a 20-30% return on some of the bigger ones?
I think it is still more than 40% discount to price to RNAV. I think initially it's around 60%. It depends upon large cap and mid cap, but it's still about 40-60% discount to RNAV. As I said, I don't expect this crisis to be a long drawn at this point of time. And my expectation is that 2020 is a bad year. It's all understood. 2021, there could be some slow kind of recovery. All this is an assumption that there is no second wave, third wave. I don't expect those kind of scenario. And possibly things should get better by 2021 first half or second half of the year. That's our base case expectation at this point of time. And as I said, Singapore government has done a lot to maintain price stability in the market, and especially developers who are local based developers like CityDev, CapitaLand has a good room to recover some of these losses which they have done. If you see REITs has already recovered a lot. And if you see most of the developers are holding the REITs. If you think their underlying assets are all still worth it, there is no point having a higher discount on the parent to me.
Okay, you hold on with the REITs. I think I want to discuss with you on the REITs a little bit later, PJ. My view is, though, I'm not almost as optimistic as PJ. I think that there will be some pain, there will be considerable pain in the economy. But I feel that the stock market is still in a little bit of a la-la land. They don't really fully appreciate, what this virus is all about. We have been largely supported, I think, a lot by the government. The JSS, have done they have done a lot for businesses. But once that is lifted, for most of them, at 75%, 50%, or the 25%, once it's lifted or partially lifted, I think that's where, the tide comes off, and you know exactly how each guy is performing. Many people will throw in the towel, and I said that there will be considerable pain in the industry. But the good news is, obviously, like what we discussed, there are policy levers that can be reversed. So the property fall the magnitude may not be as heavy or may not be as painful as that felt by some of the rest of the economy. And I've got another interesting question for Jack right now. Meg Lee is asking, when is a good time for me to sell my 99-year condo that I bought from developer since the lease is running down? What is the magic number that your agents will be telling them to flip?
Okay, seriously, you have to do your financial calculation. Okay, I believe that since you say that you bought it some time ago, you must be making some money on your existing property. So you look at it, whether you want to, cash out the money, maybe invest into another property, then you have your rental return. Because in the long run, definitely I personally believe that property, definitely the price will increase in the long run. I mean, it's definitely better that you put the cash in the bank and do nothing. Okay, so if you got this spare, I mean, after you cash out from your property, you may want to invest in two property, one for your own stay and one for investment. Okay, that will help you to establish your retirement plan in the long run. Okay, I quite believe that your property have made some money for you already, because you say that you have been staying there for quite some time.
Okay, CJ Ng has this question. Hi Jack, where do you see the price of Singapore properties in the next 12 months, especially in 2021 when the temporary measure of allowing property owners to defer home loan principal and interest payments ends by the end of 2020?
I mean, at this moment, I think there's quite a lot of good factor. I mean, you can look at it that the interest rate is really very low now. Okay, and also I think you say that the government already allowed deferred payment, deferred their mortgage loan, all this until end of the year. So you really don't see panic selling at this moment. I mean, from now until even end of the year. So if all these are good factor, so I believe that property prices will not. I wouldn't say that they'll increase a lot, but definitely hold very stable. Okay, if not, we'll have some slight increase. Okay, as you can see in China. Okay, because of the pent-up demand. I mean, demand more than supply. Then they may spike the property prices a bit. Okay, have some increase in prices. So I would say that, I mean, if you ask me, from now until year end, definitely the price will not drop. Okay, but maybe a slight increase if there is a pent-up demand that after, I mean, the situation improve.
Okay, and Tam Chen Ling have a related question. Should I get a freehold or 99 years for own stay?
Okay, I think also have their own merit, because don't forget, freehold property definitely be higher than 99 year. And also, I mean, for when if say for your own stay, of course you are thinking of passing down to generation, but don't forget, in Singapore context, is a lot of 99 year are going for en bloc in a long, I mean, in a longer period of time, because I mean, once the property is getting older, there's no economic value. Okay, so its en bloc will help to enhance the volume and the value. And in Singapore context, I think government also quite good that they, once you go for new development, they allow you to top up the lease to 99 years. So you're back to normal again. So I would say that whether it's 99 year or freehold, okay, there's really not much different. It's all depend on your financial capability and the location. Because certain location there's no freehold, then you have to contend it with 99 year. In fact, most of the convenient location that near the MRT mostly are 99 year.
That's true. Hey Vijay, you know, I used to look at property stocks in the sector itself. I mean, I used to number crunch a lot more. And back then, I realized that the fresh 99 versus a freehold, similar vicinity and all. I mean, all else remaining equal, there's about a 15% difference between a 99 and freehold. Does it still stay true?
I think the discount is still around that range of 15% or so. What you said is correct. But I think over the years, if there is one thing which can change, is that I think government is not going to give you any freehold land. So if you are thinking on expansionary trend, freehold can become a premium, or in a way that the number of freehold as a percentage of total might be reducing over a period of time. So there is some kind of premium. Still, some buyers prefer freehold because of the generational capabilities. But as Jack rightly pointed out, there is the other factor, which is the convenience, and all the 99-year-olds, which are the right next to the MRT. There is a lot of premium which is also paid to the convenience factor, which is close to MRT. So if I'm based on my number predictions at this point of time, it is still about 15% mark. A freehold versus the.
Okay, now I'll just quickly move on to REITs. What are your thoughts on REITs? Like I said, a lot of the viewers have already heard what I think about the REITs. So Vijay, tell us very quickly what you think about the sector, which is the most interesting subsector. What's your top pick over here?
Okay, I think when the COVID-19 struck, we all know that the REITs collapsed, or the way in which REITs went down was extremely sharp. I think it went down by about 15%, for 50% over a period of 1 month or so. What was happening was that, one, I think there was obviously the fear in the market. The most important thing that happened to me at that point of time was that the hot money, or the private wealth, or the leveraged money which were sitting in the REITs, were all deleveraging. Banks were pulling the financing lines. There were lack of margins, so the margin calls were happening. So the REITs this started cascading, and the REITs fell down quite sharply. Since the March, I think investors has got a better grip. And I think one thing that has changed, or one thing that is different from the past, is also that there has been a coordinated financial stimulus and fiscal response by the government this time around, which I think has changed a bit of outlook. As Jack rightly pointed out, interest rates has been quite low. Even last night, US has come out and said we are going to keep interest rates for near 0% until 2022. And there has been a lot of financial money which has been pumped into the markets. So this rebound from mid-March to now, or April to now, is not surprising. But what is surprising is the magnitude of the rebound. I definitely expected REITs to recover some of the losses from March. Now it has come back up about 40-50%, which has happened. But this magnitude definitely comes as a surprise to me, in a way positive surprise to me. I didn't expect REITs to go up that fast. Even some of the REITs are now back to the pre-COVID levels where they are at this point of time, which I think is a too fast a rally. I may not be surprised that the corrections sets in again in the near term, and there could be an opportunity. So at this point of time, opportunities are there, but I think I would be very selective, or pick out the laggards which are still not caught up with the rally. I think the blue chips have all caught up. If you look at MLT, AREIT, the big caps have all caught up and hold up quite well. There are still some names in the mid cap, small mid cap, which has been beaten up. That's usually the case. When the recovery comes, the big caps recover faster, the small mid caps take a time lag, because investors first go and buy the known names at this point of time. So I would say the opportunities are still selective at this point of time. I wouldn't be surprised if there is a correction which comes in the market, broader market, and REITs as well, which provides a buying opportunity. Because as you rightly pointed out, this crisis will have its ramifications. There is a lot of things that changed about this crisis. The way we are working from home, I'm talking from home at this point of time, and I have been doing so for the last 3 months. There is a lot of people who are talking about death of office sector, death of or working from home could be permanent, and death of retail sector. So many things has been changing. Although I don't totally agree with the doomsday prediction that everything will go to zero, there is some merits, especially on retail sector, which we think will have this COVID-19 is a tipping point, and there could be fundamental and structural changes to the retail sector in the mid to long term, in our view. Okay. For Singapore in specific. Maybe just to touch upon in terms of sectors, as I said, this sector has a least impact on industrial in our view, because people still need to go to industrial sites, and industrial cost or occupancy cost is the lowest. Office is the next preferred sector. Hospitality is our third preferred sector, because we see this as a speed bump to hospitality sector. I mean, it is not going to fundamentally change the way people will travel. Eventually, when market gets open, I think there would be a revenge tourism also. I wouldn't be surprised, because a lot of people are cooped up at home, and if things get normal by 2021, there will be a lot more travel also. But retail sector is something which we think will have a lot more pains in the mid to long term.
Okay, this work from home thing that Vijay just mentioned, there's a question for Jack. Hi Jack, with more companies rethinking about work from home arrangement being feasible, do you foresee some of the desired factors of residential property will change? Example being closer to amenities like a variety of shops, shopping malls, F&Bs.
In fact, all these are always important.
It's always right, yeah.
For whether a whole owner or investor to invest in property, because it's best that everyone knows your property is next to MRT station, definitely the value will be there. Okay, so I think it's all the time, whether it's working from home or before that, I think it's all critical. It's only that working from home, maybe people will start to look at the requirement.
Bigger place.
Right. Maybe you need a private study room rather than just
right.
this. So you may change a little bit on your behavior. The requirement of the unit layout itself.
Yeah, but for me, I think it's very applicable to the more sprawling cities. Singapore is very, very compact. But for the bigger ones, I mean like places in India, in Indonesia, Malaysia, where they are allowed to spread out more. They can go to cheaper places, maybe back in their hometowns, rather than being congregated in the likes of Mumbai, in KL, in Jakarta. So I think that the secondary markets will actually, I mean the properties in the secondary cities will actually see appreciation rather than in Singapore where it's compact, and I think it's pretty much it's very, very dense already. There's another question, Jack, can you comment on your dividend policy?
Okay, I suppose that basically there's no, I must say that APAC, there's no policy, but again, during the IPO, we more or less have set, they say that a guideline that 50% of our profit, definitely, if we have no use, will return to the investor. So from the day of listing until today, we still follow the guideline, if not better.
Okay, and okay, one final question for you. This one is quite personal, right? It said, Jack, will you be looking at a property anytime soon? Are you looking to buy a property?
I'm a believer in property. Okay, so I believe in property purchase because I really think that in the long run, really property prices will appreciate, and it's really true. I mean, from the day, I mean, every time when there's a launch, people will say, "Oh yeah, expensive." But again, this moment, if you think back, well, at that point you should buy more. Okay, so it's always, but again, in Singapore also there's restriction. I mean, there's a TDSR, there's a ADSD. So when I do property investment, I have to factor into all these factors. Okay, TDSR also will affect me. I cannot buy property forever because there is a ratio that I also have to observe. So, but I always on the lookout for property. I mean, if I'm able, I would like to invest.
Okay, great. Hey, thanks so much, man, Jack. VJ, you hang on for a bit. There's one more question before I let you guys be excused. What's your view on USD REITs with property in US, like Manulife Prime, Manulife, as well as Prime, with the unprecedented QE in US, will the hot money flow to the REITs which are listed in SGX?
I have been a bull of US REITs, US commercial REITs for quite some time. I think over the last 3-4 years, in a way, when I looked at it from the last 3 years, if I look at just the metrics, for analysts, it's most important just metrics. In REITs, there are very few metrics like weighted average lease expiry, how the rent reversions and how things are going on. And if I look at over the last 3 years of all these numbers, US REITs, US commercial REITs especially, are looking much more stronger than what Singapore REITs are. The other thing which also people must know about the US REITs, difference between US commercial REITs and Singapore REITs, is that US REITs has a step-up component, meaning if you're renting an office space in Singapore market, it's a fixed rent over a period of time, largely fixed rent over a period of 3 years. But US leases are longer, and it has a rental step-up of about 2-3% growth over a period of time, every years. That means basically organic DPU growth for the investors. And the other factor which investors is still not, I mean, especially this applies most to institutional investors, is that if you're buying a Singapore REIT, you have to pay withholding taxes, meaning the gross yield which you see for Singapore REITs is different from the net yields if you're institutional investors. But if you're buying a US commercial REITs, the gross yield, what you get is the net yield for all investors. That still makes about 10-15% of difference. So considering all, I think I still is a firm believer that the US REITs, US commercial REITs are a bit undervalued. But one thing which is certain is that US markets are a bit more cyclical, a lot more cyclical compared to that of Singapore market because of its depth and volatility. But I have been to most of the assets, I've seen the properties, and I think at this point of time, looking at how things are, I think they can survive this crisis. US REITs can survive this crisis, and I don't expect a much sharp fall in the prices. I hope that explains. Maybe if you want any specific, I can explain later.
All right. Okay, but I think that it's been a very informative session with Jack and VJ. Ethan, I think I'm gonna bid farewell to them for now. I will then take on some questions on the general market Hey, thanks so much, Jack. Thanks, VJ.
Thank you.
you.
Thanks,
Okay.
Terence. Thanks,
Thank
Ethan, for
you.
having me.
Thanks, Jack and VJ.
Thank you.
All right.
Okay, now it's my turn. Okay, I'm just gonna there've been a lot of queries about the market. There've been a massive run, and what is my idea or what do I think about it? For me, currently, I still believe very much that the market there's too much optimism in the market. We have not respected the virus enough. We have not respected the fact that China and the US, they're still at loggerheads. And when the two major economies, the top and the number two, are fighting with each other, really, it is not going to spell good news for countries like ourselves. We are a small open economy, so we will feel the impact. Remember the last time round when China and when the trade war first started in March 2018, it was just barely 2 years and a bit ago. That there was really there was a heavy impact on first the manufacturers, our Singapore listed manufacturers, and then subsequently it went all the way down to the rest of the economy. Till now, we have not felt that. In fact, a lot of the optimism has been around the fact that we are reopening the economy. Sure, that is this phased opening is definitely positive, because when your economy activity falls down to zero, then anything that pops up is going to be positive for the economy, right? So, and we may think that this is the worst. I'm not arguing the fact that we are not past the worst, because the circuit breaker was very tough. People were working from home, and a lot of times, shops cannot be, or most of the shops cannot be open. So nothing can be worse than that, right? But looking ahead, there could be another round. As we said, we are not very sure how this coronavirus is gonna act up, and if or should another round happen, I think that the markets will go on tailspin. And even if the virus doesn't return with a vengeance, the China-US issue, and I believe that President Trump moving on to re-election period, there'll be loads of rhetoric, and I think that there'll be a lot of unkind words and action on China, and I think that this is not going to be good. Remember also and the fact that Nasdaq right now is hitting stratospheric levels. Many people are saying, of course, the FANG stocks are absolute beneficiary of this current crisis. Sure, the likes of Netflix, Amazon, they benefit a lot. But with the war between China and India, I'm bringing it back again, the war between China and India, the likes of Apple, which have a lot to do with China, and should it be hit like what we saw in 2018? Remember, China, there were some measures against Apple, and then Apple stock started to plummet. That could very well still be a possibility. And given that Apple is a barometer, it's basically a benchmark, and it measures the sentiment of the entire tech sector, that could drag it down. So a lot of things can happen. There are a lot of moving parts. Understand, sure, the central banks have been flushing the system with loads of cash, and that has propped up the market. And but I feel that it takes very little for the market to see a correction at the current moment. Okay, I'm going to take on some questions that you may have. This one for sure. I mean, everybody, I expected people to ask about Sembcorp, Marine. I know it sounds a little bit complicated, but essentially that's just a two-stage thing, right? The first stage is Sembcorp Marine will go for rights issue. It's going to be a 5-for-1 rights issue. They're going to raise $2.1 billion. Next important thing, I think actually the most important thing is that there's going to be a demerger. Sembcorp Industries are going to say bye-bye, farewell to Sembcorp Marine. They're going to throw it out. They're going to basically distribute its shares to the shareholders. Of course, the biggest one will be Temasek. So now Sembcorp Marine will be directly, or not now, I mean after the whole exercise, Sembcorp Marine will be directly owned by Temasek. I've been asked by the media whether this demerger issues is going to be prevalent in the Singapore context. I cannot say, I don't think so. I mean, we are not going to see many conglomerates. We don't have many conglomerates in Singapore. But what is certain is that Temasek is restructuring. I've been saying this for a while right now. There's going to be a restructuring story. We want to streamline the operations, and this really sets the stage for an action between Keppel and Sembcorp Marine. So I think that that's not going to be far away. Near term, definitely pressure on Sembcorp Marine because they are basically raising money at they are doing rights at very, very low levels. So, but in the longer term, if you can hold, I think Sembcorp Marine may benefit from that potential merger exercise with Keppel. This structure also makes it a lot cleaner for Sembcorp Industries. Sembcorp Industries can now concentrate, on its utilities business. We are talking about the fact that this company is looking into the electrification, is looking at industrialization, looking at urbanization, and the valuation of Sembcorp Industries can be more correctly priced rather than to bear part of the losses or major losses from Sembcorp Marine. So I think that this is essentially an exercise that is near-term positive for Sembcorp near-term, so it's long-term positive for Sembcorp Industries. It's going to be near-term testing, challenging for Sembcorp Marine, but in the long term, it will be better off. In terms of gearing, we're talking about 180% going all the way down to 45%. This will, at least in the near term, before any kind of merger exercise with Keppel, this will put it in a better position to actually compete. So that's Sembcorp Marine. I think another popular question will be on that there are few GL or TLCs, Temasek Link companies that have been pretty much in the limelight lately. Another one would be SIA. Many people have asked about SIA, SATS, SIA Engineering. There's the whole SIA family. I still maintain my stance. When it popped up before something, I didn't understand why. Post rights issue, there was a pop up. But when it came down to about 360 level, I also wondered why. I mean, in the recent under the Edge or SGX talk that I gave, I was saying that at $3 plus, it is at a point in time was trading at 0.7 to 0.8 times price to book. Given that all the negatives have already been factored in, we are talking about a price to book of $4 plus. I think that is actually a decent time to take a stab at the stock. Sorry, at 360 is probably trading at 0.6 to 0.7 times. So if you were to ascribe, if you think that a proper valuation, I mean in normal times it's 1 time, price to book 1 to 1.1 times. But then these are extraordinary circumstances. If we do ascribe 0.8 times, that there's still some wiggle room. And the way that I look at SIA is that first the reopening story, which is right. I mean at one point in time, 96% of their basically capacity was mothballed. About 90% of the planes, were in the likes of Alice Springs and in Singapore Changi Airport, not flying. But as right now, it's a lot better. There are a lot more planes out there, and I believe that this will actually help the cash flow. They are going to raise $8.8 billion. That will be able to allow them to tolerate a lot of stress over the next couple of years. And the Singapore government won't allow. They've already said, and I do believe 100%. That they won't allow this industry to falter. It is too important. It is too strategic, right? So Singapore, SIA wouldn't go bust. At $3 plus, I think it's decent. At mid-fours, possibly not. You may have to take a longer term view if it's mid-fours. And what are the chances of hyperinflation with Fed's unlimited QE? I mean, I think I'm very worried that the printing of money, but to hit a hyperinflation like what we saw in the 1930s, I think a little bit less likely. There's always a flight to quality whenever, and US is able to continue to print money right now because they are the US, right? And they can print their way out of issues. Of course, the next generation, or the current generation, will have to stand behind and they have to make sure that there's enough economic growth for them to continue printing the money the way they have done so. but many other economies will not have that kind of capacity. I believe only in the US and to a much smaller extent, Europe, that will be able to do that. The rest of the economies, you cannot print yourself your way out of problems. Think of developing countries like India and Indonesia, right? Nobody's going to take on that debt. And if they were to do so, then I think hyperinflation will start to set in. So they are caught between a rock and a hard place, and it's very difficult to get themselves out of this, I think, dire situation, more so than, say, the US. Oh, sorry, there's a question on sets, which is related to SIA. I did mention, there's certain levels that I think SIA is more attractive. For sets, given that 70 to 80% of the business is aviation related, they are of course very, very tagged to the likes of SIA, the likes of Changi Airport. The reopening is, I think, definitely something that's good for them. At least the workers can come back, on stream to work. They also have been helped a lot by the JSS. But in terms of valuation right now, the year end is in March, just following SQ's calendar. Year end is in March. FY 2021, which we are in currently, that will be the worst. They definitely is a write-off. In fact, we are right in the midst of the worst quarter. The first quarter of FY 2021 starts in April, ends in June. That will be the worst quarter. But going the whole 2021 wouldn't be pretty. They're going to be in losses. But even if we see a pickup in 2022, it will be nowhere near where we were in, say, FY 20, which just ended. The valuations will be, I think, in the 30 to 40 times range FY 22. What you can play on is the recovery, but even recovery, you have to look 2 years ahead, and the valuations for 2 years ahead is still relatively hefty. So I think it's probably a hold at this point in time. Singapore banks, what's your view when NIM will drop and provisions for bad loans will rise? Will they be able to maintain 5% dividend yield? Oh, okay, I've commented on this quite a fair bit. I think that there are a few issues with banks right now. So or at least for the last 2-3 weeks, when the massive run came for the banks, I was quite puzzled, given that really there are a lot of negatives out there. One is loan growth. It's not going to be any loan growth. People are spending less, and people are a lot more cautious. So loan growth, not altogether there. In fact, it's going to decline. The NIMs, the net interest margins, will also be compressed. For the very fact that, and that's why you can see when you put money in a bank right now, they are now also reducing the rates, because and these rates are going to be lower for longer. So we're going to see a compression, and that's very, very key to banks, right? And another thing is NPLs. There's going to be a lot more performing loans, given the economy is not going to be in the best of shape. All these are going to pressure the banks. For now, or as far as I've read, I think DBS is still saying that they can do keep their dividends. OCBC is a little bit shaky. For me, I think that in the at least for this year, there's a good excuse for them not to dish out the dividends, even if they really, really can. But I think that to be conservative, they can actually say, okay, this year give us a little bit of holiday. We have to relook at the finances, and nobody's going to afford that. Just like Singtel. Singtel cut their dividends. That was a shocker, right? That's why the Singtel price just plummeted. We were so used to the 17.5 cents dividend. In fact, there was no indication that they're going to cut the dividend until they made the announcement. So if Singtel can do it, I think that the banks can also follow suit. So we're talking about 5% yield right now. That I believe for the banks is not a certainty. When advised not to go into the market right now, I think that the question is, so will you advise not to go into the market right now? The short answer is yes. I feel that there are still a lot of uncertainties, like I said, with not only the virus, but with the trade war, and and I think that a lot of the negative sentiment will start to trickle in. Should they wake up and look at the valuations of the market? Not only as STI, we have the analysts have also only like downgraded, I believe, at this point in time 20%. During the GFC, they actually like slashed it over the cost of 40%. I've always said, you know, as an analyst, I was an analyst for 15, 16 years before I started my fund management business. 15, 16 years, and I've seen analysts, we are very, very slow to actually reduce the earnings. You know, we should, you know, if such a major crisis comes, just be a bit more garang and slash the earnings, but we are not, right? So the earnings, expected earnings is still going to be relatively high to what I feel is going to be a reality, because the market, or at least the companies are really reporting that there's going to be a massive drop in demand and all. We have not fully put that or factored that into the expectations. So the PE may not seem very high for now, but the real earnings that's going to come through, I believe the real PE will be a lot higher than what we are accustomed to, and I think that will be a good reason to actually see a drop in numbers. In fact, if you look at S&P 500, which is a broad-based index, that broad-based index is already at possibly the second highest valuation of all time, next to year 2000. Okay, now it's past 1:05. I'm going to take just a couple more questions. Then, if anything, you can actually go to either Investing Note or my Facebook, my corporate Facebook page, and I'll take on some of these questions. I've already done this Sembcorp demerger exercise. Some of these are for Jack. Since I was talking about Singtel, I think that that's another very popular company, because it is, after all, the largest listed company out there. I feel that Singtel, after the results, it plummeted, and because people were not expecting a cut in the dividends. But if you look at some of its core associates, the one in India, Bharti, Telkomsel in Indonesia, Globe in Philippines, I think they are doing relatively well, and it's above expectations. Of course, you have to measure against Singapore, Australia, where roaming business is going to plummet the current quarter. So lots of things, and it also has its financial year in March, right? So this year it's going to be challenging. But I don't think it's going to plummet. We're going to see the numbers come off, say the airlines, right? Or even the banks. I think it's going to be relatively more resilient. But given that the yields, which is what a lot of people are buying Singtel for, that has gone down to about 5-ish, high 4s and low 5s. I think that it is a decent level to hold the stock. Should it come off where we were when after they announced the results, I think that that's the time to really collect on Singtel. I'll see whether there's a Singapore Sheng. What's a good level to enter SGX? SGX, of course, there's a lot of issues. There's a lot of issues with SGX right now. Then we are talking about SGX having very, very major issues because of the exit of MSCI. But I think that they do have capacity to. They do have the next few months to actually look for a new business or to solidify their relationship with FTSE. So I think these are the positives that I see in SGX. And SGX is very, very volume driven. We are talking about we are talking about the SDAV right now, and I think that should there be problems out there, then people will see a massive sell volume, like what we saw in March, February moving on to March. But should things improve, there's also going to be buying volume. So I think SGX is relatively resilient. Now we really need to take a look at how how they are going to rectify the situation, because MSCI still accounts for a big part of its revenue. REITs, I think VJ has already taken that. I do agree with some of the things that been saying. Okay, I think I'll end off with Sheng Siong, staple food industries. I mean, basically the staple foods. In particular, Sheng Siong. My view for Sheng Siong is that I feel that of course there's a lot of hype regarding it, and this is not just hype. Actually, I take that back. They have improved tremendously in terms of their earnings, because people are working from home, people are staying home, they are cooking a lot more, and essentially the supermarkets are the only places that these guys can really go to, right? I mean, for myself, if there's really no places that we can go to shop or what, so people do tend to head to the supermarkets, especially during the April, May, the circuit breaker period. But as the economy opens up, there's going to be a little bit less shopping. There's going to be a lot less cooking. People will maybe visiting the restaurants in the next phase. There's going to be some pent up demand. It's not Restaurants are going to not going to be drawing the type of crowd that we have seen in the last, like during normal period of time. But it is going to be a lot more than, say, April, May, which is zero, right? So anything more than zero is very great. And Sheng Siong may see a normalization of its business. Currently, as we are seeing that we have ascribed big growth into Sheng Siong, but should it normalize, then I think that the valuations should go back to normal. I think the normal valuations, we're talking about 18 to 22 times, but it's trading at 25 to 27 times. So I feel that while it is a great business, and they've run it, and the Lim family have run it very, very well, but at a certain point, as the economy opens up, this will be one of those that one of the counters that would see some pressure. Okay, and I think we've come to the end of the session. I mentioned, you can always pop in and ask me any questions you want, or any kind of burning questions you have. And thanks so much. It's been a very, very eventful last few weeks. The stock market continues to head north, but I've been saying this, last couple of months, do be very, very cautious, because if people do start wondering about the valuations, do start looking at focusing back on reality rather than to look through those tinted glasses. I feel that there is going to be some pressure point on the general market. Okay, with that, thank you everybody. I'm heading off. Thanks, Ethan. Back to you.
All right. Hey, thanks, Terence, for the wonderful live market commentary, as always, right? And thanks, everybody, for taking their time to actually watch this live webinar. So this live webinar we recorded and be on our YouTube as well. So stay tuned for the next one. All right. Thanks, everybody.